Over the past month, I've continued to build my long-term dividend growth stock portfolio. The goal is to build a compounding source of passive income while hopefully beating the market total return. With this in mind, I just made a sizable change to my portfolio. I decided to sell one of my stocks and put a large amount of capital into a new stock that many dividend growth investors love. Today, I'll explain the logic behind that decision and share an update on my overall portfolio. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe if you enjoyed the video. You can support the channel and track your investments just like me by becoming a member of my website, dividenddata.com. I personally developed this tool for dividend-focused investors. You can use it to track your stocks across multiple portfolios, calculate your yield on cost and projected dividend income, manually record your earned dividends over time, and get breaking dividend news based on your holdings. On top of all this, you get access to my in-depth fundamental stock research tool. Joining dividenddata.com is the best way to support me, and it costs only $10 a month or $100 a year with a 30-day money-back guarantee. Now let's take a look at my portfolio. The current value is $110,146 with $94,259 initial dollars invested, putting my total return at 16.85%. My holdings include Microsoft, ExxonMobil, Altria Group, Disney, T. Rowe Price, Apple, Broadcom, Texas Instruments, Kroger, PepsiCo, Visa, Chevron, and EPD. These investments have varied greatly in success thus far. Even in my top holdings, Exxon is up 207% and Disney is down over 33%. All of this is part of the learning experience as I continue to increase my investing knowledge. For those of you who don't want to spend time analyzing individual stocks, there are plenty of ETFs and mutual funds which follow a dividend growth strategy. For example, SCHD is very popular among dividend investors. So popular that it seems like the dividend subreddit has become a cult for the ETF. Personally, I like to invest in individual stocks as I enjoy the process of analyzing companies. My projected annual dividend income is $3,263. My dividend yield on cost is 3.24%, and from reinvesting dividends, this has boosted my yield on cost to 3.46%. That's a snowball effect of 0.22%. Here you can see all my individual stocks and their dividend statistics. Altria is my largest dividend payer with an annual income of $1,120. My yield on cost is 8.64%, and from reinvested dividends, this has been boosted to 9.23%. We call this a dividend snowball effect of 0.59%. I've owned Exxon stock since the fall of 2020, and I have a yield on cost of 8.9%. From reinvesting dividends over those 2.5 years, I've acquired more shares and boosted my yield on initial cost to 10.11%. That's a snowball effect of 1.21%. This means I'm earning $10.11 each year on every $100 I invested in ExxonMobil from the dividend alone. Now those are my higher yield stocks, but both earnings and dividend growth is an extremely important part of the equation when investing long term. Some of my highest growing dividend stocks include Microsoft, Broadcom, Texas Instruments, Kroger, Apple, and Visa. I would also include T. Rowe Price in that, but they recently had a very small 1.7% increase. However, that's extremely understandable as their earnings move with the market, and we clearly have been in a bear market over the past year. Overall, the diversification of my portfolio is heavily weighted towards technology, followed by energy, consumer defensive, financial services, and finally communication services. As I mentioned earlier, my projected annual income is $3,263. This is $815 every quarter, $271 every month, $8.94 every day, or 37 cents every hour. Since all my stocks pay quarterly, they are distributed across these 3-month cycles. This March is my highest paying month, April is second, and May is my low month. Here you can see a projected calendar of the stocks which make up each month. On the upcoming dividends page, you can see my declared dividends coming up with their declaration date, execution date, date and payment date. Ultimately, the plan with this account is to build a compounding source of dividend income. I will grow this over decades, with it eventually generating enough income that I theoretically could live off of it. At that point, I can take those dividends as cash or continue to reinvest for more growth. That is true financial independence. Since I started dividend investing, I've earned $7,994. Year to date, I've earned $481. My income has fluctuated over time as my portfolio has changed, and I've focused more on a dividend growth strategy. Last month was my smallest in a while, with $103.59 in earned dividends. This month, it's only March 1st as of the making of this video, and I've already eclipsed it with $113.65. In February, EPD paid me $58.28, Texas Instruments $33.70, and Apple $11.61. I reinvested these dividends to acquire more shares. To start March, I earned $6.79 from Visa, $21.74 from Kroger, and $85.12 from Intel. Now, some of you may have noticed that Intel is no longer in my portfolio. That is true and gets us to the main topic of the day: why I sold my Intel stock and what I bought to replace it. Now, I recently made an entire video breaking that decision down in detail. I recommend you watch it, but here is the short reasoning. Intel's earnings have collapsed over the past year and are projected to remain poor throughout 2023. On top of this, they are spending tens of billions on building out new chip fabrication plants as they attempt to take on TSMC. To help fund this business transformation, Intel decided to cut the dividend by over 66%. All of this, along with other factors outlined in my video, completely eroded my initial investment thesis with Intel. For those reasons, I sold my Intel stock. I sold at $26.11 per share, around a 20% loss, netting me $6,084. As always, you have to take these mistakes as a learning lesson. From my poor prior experience with the AT&T dividend cut, I decided to sell right away with this Intel news. In fact, I'm starting to notice a trend around my worst investments. With Disney, Intel, and AT&T, they were all turnaround stories. Each was going through a unique decline in earnings and costly transformation. It doesn't mean that it won't eventually work out for these companies, but it's smarter to wait until there's evidence of success. It's much easier to invest in a business with a reliable business model, growing financials, and dividends. So what did I buy to replace Intel? I purchased 11 shares of Broadcom, ticker symbol AVGO, at a cost per share of $577.44. Broadcom is loved by dividend growth investors as they are a free cash flow machine with fast-growing dividends. Over the past 10 years, the compound annual growth rate of the dividend is a massive 39.22%. Now, of course, this has slowed down significantly, but they are still growing at a high rate. In fact, they just announced a 12.2% dividend increase. While still a semiconductor stock, Broadcom is practically the opposite of Intel. Intel is a costly manufacturing business. Broadcom is a fabless company who focuses on design and can run to generate free cash flow. For context, in fiscal 2022, Broadcom generated $16.7 billion in operating cash flow. With only $424 million in capital expenditures, that put free cash flow at $16.31 billion. This is pure cash that the business can use to reward shareholders and invest in acquisitions to grow the business. Meanwhile, in fiscal 2022, Intel generated $15.4 billion in operating cash flow while spending over $25 billion in capital expenditures. That put free cash flow at negative $9.6 billion. While Intel may improve earnings in the coming years, they will still have to keep investment high in order to compete with the likes of TSMC. This shows the massive difference between a company like Broadcom and Intel. It's clear that Broadcom fits the dividend growth strategy far better. As long as they continue to grow free cash flow at a solid rate, dividend growth and total return will be fantastic. Even if growth slows down, I'll expect returns to still be very solid. Over the past 5 years, free cash flow per share is growing at a 24.13% compound annual growth rate. In fiscal 2022, free cash flow per share grew at 22.75%. That is crazy good. On March 2nd, Broadcom is about to report earnings, which will be a strong signal for how they expect 2023 to go. sell. If the stock drops significantly, I may be buying more depending on the cause. I'm currently working on a full Broadcom stock review video, which will be coming out soon. Subscribe to make sure you see that. Aside from this large Broadcom stock purchase, I also bought one share of Microsoft at $246.67 and 2 shares of TROW at a cost per share of $111.21. With TROW, I will buy as the price falls, but I am staying disciplined with my buying. It's important to keep in mind the risk of a prolonged bear market. Microsoft is a core position of mine moving forward, so I will continue to dollar cost average and buy on dips. However, all of this is just my opinion, and be sure to do your own research before making any investment decisions. Thank you for watching Dividend Data. You can sign up for dividenddata.com to track your portfolio just like me and join a Discord community of like-minded investors. Also, you can access the research tool I use throughout the video. Follow me on Twitter for real-time dividend news, and thank you for watching.